Thank you so much, Alicia. Henk and Thalia, welcome to our studio. It is the last session, so I'm quite excited about the insights that you're going to share with our clients. I think let's start with SA's move towards a low inflation target. The question I think is that is it actually going to be a guarantee of lower interest rates over the long term? I think I'll start with you, Thalia.
Okay. So I would say, for me, probably what's important about the move to the low inflation target is, in some way, it's in response to the fact that inflation has already arrived at 3%.
Okay.
So we're here already. I think now we're at 3.6-ish, Henk. But over the last year, we've averaged 3.2. And then in terms of will it guarantee lower interest rates, so we're already quite deep in the rate cutting cycle. So we started at repo was 8.25 at the peak, and we're now 6.75. So I would say we've already done a lot, and we're probably in the home stretch.
Okay.
That's I guess the debate is how much more do they have to go. But the market is pricing for terminal repo rates at 6.25. And how are they getting there? Well, I think, to be honest, they're just copy-pasting the SARB's model.
Is that your sentiment? Do you share the same sentiment? Where do you see sort of cash settling maybe towards the end of the year?
Yeah, so good afternoon. Thanks, Gladness. Thanks, everyone. Thanks, Thalia. It's obviously great to be here. Maybe a little bit more bullish or constructive from our perspective. What's interesting, if you think about the inflation narrative and the sort of move towards 3, yes, absolutely, the opportunity was there to move because of where we are structurally on our inflation story. But we need to think about the market's reaction to that and the credibility of the SARB, et cetera, et cetera. So, we can dive into a lot of the different nitty-gritties, and I'm sure we'll cover some of them. But if we take something as simple as an interest rate inflation swap, it's an instrument that gives us a good sense of what the market expects inflation to be over the short, medium, and longer term. Those are all sort of 3, maybe sub 3.
Okay.
So the market's giving us the opportunity to say, we expect inflation to be structurally lower going forward. The SARB's credible to keep us there. And for that reason, real rates, I think, in the front end should be a little bit lower than where they are currently.
Yes.
Right? That's the opportunity for us. So terminal rate probably around 5.5 is
Okay.
close to what we would see.
All right.
6.25, 5.5, it's not miles apart, but potentially a little bit lower.
Okay, and also given deglobalization, and geopolitical tensions, do you then think that inflation could actually surprise on the upside?
There's always risks, but the market is very, very efficient in pricing those risks, right? So if we think about the actual market pricing, that's not really reflected. And the flip side to geopolitical risks and all sort of decentralization, et cetera, is obviously the productivity gains, right?
Yes.
And we've seen quite a lot of different examples of productivity increases. One that we all know about and love to talk about is obviously artificial intelligence.
Yes.
And if we think back to last year, one of the key sort of developments in artificial intelligence was the emergence of what we call DeepSeek, right? So from OpenAI and all the sort of things we know, and then DeepSeek comes out and cuts that cost by half. And now, most recently, Anthropic came out, and again, did something similar, right? So the cost of productivity for us is going down, and that's probably going to be a stronger counterweight to structurally high inflation than potentially lower.
Than lower, okay. And then you also mentioned that, of course, this move to the 3% target implies that compression of real yields, at the front end of the curve, with money market and cash yields, potentially heading lower. Thalia, how are you thinking about that environment, specifically within, the fixed income portfolios, where, we are expecting that front end to be a bit lower?
Yeah, so maybe we'll disagree on this point. I can already actually. I think a lot of the moves already happened.
Yes.
And even if, so as we just laid out, the market's pricing for the terminal repo at 6.25. Maybe if Henk's right, it's 5.5. There's more to go than what the market thinks. But a lot of wood has already been chopped. And so from a positioning standpoint, and if I orient it back to our interest and income funds. We have had, I don't want to say a high duration weight, but maybe for the category a high duration weight, and that we've been in the interest fund at about 1.3 and in the income fund up at about 2 modified duration, which versus a bond fund is nothing, but for the category it's high, and we've had quite a tilt toward fixed rate, fixed rate bonds, fixed rate money market, anything fixed rate, but we kind of got into that position. If I think around May 2024, we entered like fixed rate money market yields were giving you like 10% in 1 year. So, I mean, it was crazy. And then we added to that in kind of the 5-year bond space at kind of 9 to 9.5% yields.
Okay.
Now, we're in the situation where, the 5-year bond is giving you 7.4. So, I mean, and 1 year money market's giving you 7.
Okay.
So, in my mind, it feels like a big part of the rally's happened. I don't feel like there's very much
Runway.
juice left to squeeze.
Okay.
So if I think about it from a positioning standpoint, we've actually cut the duration. So in the income fund, from 2, we've gone down to about 1.3. And in the interest fund, we're now below 1. So I would say we could be sort of average to moderately below maybe where peers are, somewhere around there. And then in terms of fixed versus floating, we've got quite a tilt now to floating.
Okay.
Just because I feel like there's not very much more left. But, if Henk is right, maybe there'll be a bit more runway. Yeah. One thing, I struggle with is, so it's not that I'm incredibly bullish on inflation, that I think we're going to head back to kind of the old days of, 6% average. But I feel like to get down to like, 2, 2.5, 3, maybe between a 2 to 3 band, and then have, normal repo at 5.5, like everything has to go perfectly.
Yeah.
And our basket is, it's pretty noisy. We obviously, it's a smaller open economy. Any kind of move in the oil price, the SARB can't control for that. It's going to hit us.
Yes.
The rand's quite a noisy currency.
Lots of moving parts. Yeah.
Lots of moving parts. Yeah. I mean, it's been benefiting in the last year from this anything but the dollar trade, which filters through into imported prices. But yeah, I struggle to see sort of a perfect scenario. And also administered prices is one where probably, but I mean, everyone is kind of probably well aware of this. The SARB speaks to it quite often at almost all of their MPCs. That's one where you're tracking well above, current inflation at the moment. And you have the potential for this unborn cost in terms of the fact that, we haven't done the requisite infrastructure in terms of energy, the electricity grid, in terms of water, that cost is ultimately going to be borne by consumers in higher tariffs. I mean, we're already seeing it come through in a host of administered prices and municipal tariffs. I think that could be a noisier part of the basket.
Okay, that we're not quite paying attention to. But also just talking about, how much juice is there to squeeze when we referring to the bond markets. I mean, bonds have done spectacularly, incredibly well. I mean, 12% at Liberation to about, 9% right now. How much more runway? And do you think, this rally is quite sustainable? So what's your thinking about that? Especially since we're seeing that, there is no growth coming through. We're still sort of stuck at the 1% level. So the yields are not really justifying, the returns that we're seeing.
No, I think we're closer aligned than what you potentially think. So there's obviously different parts of our yield curve.
Yes.
If we're thinking about at the front end, or where we would sort of see money market rates, we are quite constructive. What we would call moderately positive. And on the bond side, a little bit longer out, if we take the 10 years as an example, or the old bond index as an example, we moderately negative. So what's interesting about fixed income, and the beauty of it, and that's why we kept it for last today, the best is always last,
of course.
is that bonds trade at a price, so we know that price. It translates into a yield. Yeah. We know the sort of tenor, so when it's going to end or mature. So we know more or less the sort of path it's going to take over the next 12 months. That's sort of what we call the roll down. So with the price, the yield, the roll down, we have a very good sense of what we should expect for the next 12 months, right? The only piece of the pie or puzzle we don't have is what we actually expect yield levels to be.
Yes.
So if we have a good sense of that as well, which, I mean, that's why we do what we do, we can put all of that together and give you a sense of what we expect to return. Okay.
Thalia, is the current yield making sense for you right now? In terms of where we are, are you thinking that there is more runway in terms of bonds? What's your view? Is it different from Henk's?
Well, I mean, as you said, I don't think we're actually that misaligned. But yeah, I mean, I think yields have run hard. I mean, that 9%, so that's kind of out of the 20-year part of the curve. And as you say, we came from kind of 13 odd. It's run hard. Some of that, one could justify by saying, okay, we're going to run, and we're already running a structurally lower inflation versus the US than we have in history. So that's one part of a bond fair value model. The other part of a model is, your country risk premium, which is subject to all the vagaries of a subjective estimate like that. You can input, the credit default swap spread, etc. But, that's prone to shifts in sentiment.
Absolutely.
So I tend to think it's run hard, and I think maybe we priced for perfection right now. Where I could be wrong, obviously, is, inflation, deeply surprises on the downside, and instead of 3, maybe, we fall in some, 2.5% or 2% kind of camp. Or it actually just ends up being a flow story. So, okay, maybe, your fundamental fair value model now says bonds are looking expensive, but foreigners say, well, I don't really care and I'm not using a fair value model and I'm just looking for a little bit of yield outside of the dollar because I'm feeling bearish the dollar. And I think we've already seen, a lot of those flows, but maybe one sees a continuation of those flows. And I also think, for foreigners coming in, a big part of coming in onto SA government bonds is also their outlook on the rand.
Yeah.
And, they look at the rand and say, okay, well, politically things are looking pretty stable. They like the GNU, they like the commodity story, the gold and PGM, exposure that we have. I think a lot of that's played out. So I struggle at these yields to say, okay, it's a screaming buy. And as I said, we've been lightening up on duration.
Duration, yeah.
Yeah.
Okay, and just speaking to country risk premium, Henk, we spoke earlier, Justice spoke earlier about, the local government elections, that we should ignore all that noise. How do you think that's actually going to have an effect on, the bond yields this year?
Yeah, so maybe to go back to something Thalia said around the sort of fair value and how you could think about a bond. Another way we break up a bond is by looking at the average expected short-term rates.
Yes.
And then the difference between that and your 10 years, what you get paid for taking on that risk, to your term premium.
Okay.
And if we break that down further, the term premium component has a real term premium in, so the inflation story, and then a compensation for unexpected inflation.
Okay.
So the question around where are we going with inflation, what are the risks of inflation? If we look at South Africa and look at that inflation risk premium, that is compressed from about 1.8% all the way down to 0.2%.
Okay,
so the market is telling us
Mm-hmm.
a lot of credibility around the SARB,
All right.
and we're going to get to those sort of levels, and not a lot of risk in us not being at sort of the 3% level. So that's just an interesting dynamic to think about when we're thinking about uncertainty around inflation. If we go back to the politics question, it's our view at Prescient that our bond yields are predominantly, if not 80% or more, driven by what happens globally.
Okay.
So our political and sort of local elections sort
not
of
affect
noise around the
Yeah.
sort of long-term trends,
Okay.
and they are important, absolutely. Things like the structural shift in inflation, these things you need to think about. But we're actually quite bullish on the local politics scene. So, that potentially has a stronger sort of push down than up for us, but that's not the sort of key driver for what we
for what you
see. So our key sort of, there's a lot other drivers that look at our bond
specifically global. And also just on, inflation, Thalia, how are you thinking about inflation linkers in this environment? Are they still attractive? I know Fua did mention that, they still are liking inflation linkers. Is there still a place for them? Are they still attractive, especially, with the trajectory, the downward trajectory?
Okay, well, so we don't own any in our interest or income fund. I don't know if you have.
I'm very glad you're taking the question.
Oh, okay.
I think you have inflation linkers.
No, we do not.
Okay. So we don't have any in our interest and income fund.
Okay.
Yeah, I'll say, so they haven't done as much as, the ALLB, the fixed rate bond index. Okay. If you look at, let's say, 2-year rolling returns, the All Bond index has done like 20% per annum over 2 years. So, star performer. And I think the inflation-linked bonds have done maybe 12, 13%, somewhere around there. So it's underperformed, and that's sort of to be expected because people are pricing now for low inflation going forward.
Yeah.
Where are we now? So, the whole curve, the inflation-linked bond curve, is flat at about 4% real yield.
Okay.
So what that means is you're going to earn 4% plus whatever inflation is. So, you're looking at like a 7% return.
Okay.
If you believe 3 is the new normal. And as I said, you can get 7% on money market. So it's not very exciting. Obviously, if inflation overshoots for any of the reasons I mentioned, maybe, we average 4, then you get 8. I still think 8's not very exciting.
Okay.
When you're taking on the modified duration risk of these linkers. So these linkers are, they've got this big balloon payment at the end. So the modified duration is huge. That's the interest rate sensitivity. I think the inflation-linked bond index, the average modified duration is about 10.
Sure.
So, it's not for the faint-hearted. Some of the short-end ones look okay. Like we have some in multi-assets outside of interest and income fund, but I wouldn't say it's not very high conviction
Okay.
call.
Okay. I suppose you're nodding your head in agreement.
100%. Yeah.
Okay.
So again, if you think about the way we would build our portfolios, all the different tools we have, and you think about all the different expected returns we have and the risks that they introduce,
That's the
Thalia
list. Okay.
hits it on the head. Optimally, you don't want to be in linkers in our view for sort of front-end heavy
Yes.
portfolios. Yeah.
Yes. And then let's just move on to credit. I mean, the credit spreads are quite tight. Where are you still finding value within, corporate credit? And also, if you could maybe speak to, the CLNs compared to your vanilla corporate bonds, how are you playing those two?
I think the credit topic in income and or fixed income portfolios has been quite an interesting one over the last couple of years. We've been singing the same sort of song for a while, where we don't see credit spreads in general being sufficient for the risk we're taking on in the credit space.
Okay.
We actually structure negative on SA credit.
Okay.
But that doesn't mean there's not opportunity, right? It's just where we have to find the compensation for the risk. So we like banks structurally as a sort of more defensive play, sort of asset-backed certain parts of the listed market. And then at Prescient, we're very proud of our unlisted process as well. So finding some opportunities in the unlisted space, again, with the right sort of fundamentals.
What proportion is that unlisted?
No, it's small.
It's quite small. Okay. Okay.
But what is interesting, if we think about the credit space, and I'll let Thalia, also very, very sort of expert in that space, there's something new coming to the market. Maybe not as exciting, something we call FLAC. So it's a bank bond that they're going to issue. We've seen the first one issued by Standard Bank. That's for first loss offer capital. That's what it stands for. And the expectation, at least for issuance in that space, is between sort of 280 billion to 360 billion over the next 4 to 5 years. So that's quite a lot of stock that comes to market, right? And how the rest of the credit spread market behaves and reacts to that is going to be interesting for us to see. I mean, hope is not a strategy, but certainly hoping for a little bit of spread widening, so there's a bit more attractive yield
on that side. And are there other yields more attractive on the CLN side, on the credit-linked notes?
So, I mean, it depends on point in the cycle, I would say. So, I mean, we have used credit-linked notes in our, like, for example, in our income fund. At times, it's actually been quite high. So it's been as high as 18% of fund. I think we're going to end the week at about 10. So we've brought it back a lot, and in the interest fund, we're going to end the week. It's sort of immaterial. It's going to be, I think, 1% or less.
Okay.
So it's very much for us. It's point in the cycle. It can give you really good returns, but we believe in I guess marking them to market and then taking profit when it makes sense. Because if the cycle turns against you, and I mean, obviously we've had this big, bull run now, it's been positive if you have like a bit of extra leverage in certain parts of your portfolio, but if you don't take it off, you can face the other side and ride it, downside in terms of price. And one saw that, I guess, in 2020, it was kind of a perfect storm for credit-linked notes, in that government bonds were selling off, but the SARB was cutting interest rates, and very often that's the hedge people use, is actually the interest rate swap curve to hedge out the duration on the long bonds. So it's a perfect storm where you lose on the bond and you lose on your hedge. So you'll actually underperform government bonds. And there was a period of time, a lot of these credit-linked notes were incredibly underwater. We actually didn't have any, but one can observe the pricing. It was, you could have been down 20% on these. So we believe it's not a through the cycle play. I'd say that would be my answer. Yeah.
Thank you. And Henk, how do you think of SOEs within the portfolios? Do you have some positioning there? Are you only looking at the government-backed SOEs?
Yeah, I think, again, similarly to sort of the question on credit and the answer to that, it kind of depends on what you're getting paid and where you see the valuation.
You have one answer for every for every question.
Well, that's the way we have to think about things, right? Risk and return. But specifically around SOEs, government guaranteed obviously makes it a little bit easier for us to get involved. One or two select SOEs we like, specifically IDC and Development Bank SA, so DBSA. But then again, when we say that, it's sort of sub 4% of all of them combined in the portfolio level. So it's small exposures, very few pockets of value, but one or two.
Okay. And then just sticking to your portfolio, you do have some foreign exposure, I think slightly more than what Thalia has. Well, how are you thinking about the sort of your local versus offshore fixed income opportunity?
Yes, great question. So offshore we think about in two ways, right? So the one is your physical exposure offshore that we think of as a yield play. So that we always hedge back into the currency, the rand.
Okay.
So if we can buy a SA bond in the offshore market at say 5 in dollars, we can hedge it back at 3 using the currency differential, gives us 8. And then we'll look at the local version and see what that looks like.
Yes.
If it's more attractive offshore, sometimes that's the case, then we'll have some offshore. If not, then we bring it back. Okay. The second component to that is obviously then the currency exposure, right? So do we want to take additional dollar exposure on a fund level?
Yeah.
And that makes sense if, for us at Prescient, we think about the risk in a portfolio. So last year duration was sort of the key driver of risk.
Yes.
A good hedge against duration, if we think back to any previous sort of bust, is having some dollar exposure. So optimally, for us to have, say, 1.5 to 2 years duration, it's a good thing to have a 5% dollar hedge. So that's how we would think about that. Currently, not that much dollars, and all the sort of offshore will be hedged.
Okay.
But we haven't increased that too much in the portfolio.
And Thalia, your positioning on offshore, how are you thinking about that? Because I know it's still quite a small component.
Yeah. So we have, since the income fund launched, we have had, at times bits of offshore exposure, but we've only ever had it hedged back to rand.
Okay.
Which I guess over the time period that, we've had the fund in existence has been a good call. But I think the bar to us adding naked dollar risk would be extremely high. It's not something, we have plans to do. Partly because of just the volatility it instills and actually, the performance of the portfolio and returns. And then also it probably has to do with the fact that, we have different product offerings. And as you know, we already have our stable fund, which is our low equity, kind of lower foreign, kind of higher fixed income offering. And we don't really want to muddy the waters between that and our income fund, which is primarily, rand-based. So yeah, the hurdle rate would be very high. As I said, we've never taken naked dollar risk. But similar to what Henk has said, what's quite interesting is you'll have, let's say, a corporate issuing here in South Africa, for example, at, JIBAR plus 1.5%. So whatever it is, 8.3%, 8.4% yield, and then the same corporate's offshore debt, if you go and swap it back into rands, so put on the hedge, you can get, JIBAR plus 4%.
Okay.
So often there's, I don't want to say mispricings, but different pools of investors, maybe with different comfort levels, maybe a little bit of mispricing as well, in the SA market where there's just so much cash in this income fund category, it naturally puts downward pressure on spreads. So we take advantage of opportunities like that, but on a hedged basis. Yeah.
Just taking advantage of opportunities, Henk, you also hold some preference shares in some property. Because this is obviously a multi-asset sort of fixed income panel, can you give us your thoughts around how you're thinking about it? I know it's quite small, but just to cover all the assets that you that are in a universe, how are you thinking about the pref shares and property as well?
So we launched our income provider portfolio sort of the start of 2000, and we listed the unit trust 20 years ago.
Okay.
So it's got 20-year track record now. And why we launched it back in the day was really a client that came to us looking for a solution where, one, they can have regular income, so they can live from the little bit of savings they had. It was a beneficiary trust, predominantly widows and orphans. And we said we can structure a portfolio for them that, one, will keep up with inflation, so inflation plus 3, that's the target, return target. But more importantly, and this is the key one, why I'm going to answer your question, but taking a long way around, is our risk target. So in the portfolio, we always structure the portfolio at all times to make sure we don't breach the zero line or lose money over any rolling 3-month period.
Okay.
So it's quite a short capital preservation target. Okay, so we're very surgical when it comes to that. Now we've got to think about the universe of different building blocks that we can use. Preference shares and property are both great assets for an income fund. We need to think about what risks do they introduce.
Yes.
So we've liked the preference share market for a while. We only held the banks. We were of the view with the change of regulation in Basel, etc., the banks will come and buy them back.
Okay.
That did materialize,
Okay.
and that was a quite nice uplift for the portfolio. So the remaining pref is really Standard Bank.
All right.
And the pref yield for us makes sense for what we see. Then on the property question is probably a bit more interesting. If we think about the risk target and you think about what property can do in sell-offs 2017, COVID, etc., the left tail, the ability of listed property to show large drawdowns with that risk target in mind makes it very difficult for us to have large exposure to property.
Yes.
Our view on listed property is not constructive at this point in time. So unless we have a very strong view, we're not going to have a lot of property in our portfolio. So the current property exposure is 0.2% as an example.
Okay, perfect. Thank you for that. We've got 5 minutes left, and I was told to really be strict on the time. So I think in closing, Thalia, I'm going to ask, what is the single biggest risk keeping you awake at night? That's the first part. And what are you most excited in your portfolio right now? Henk, I'm going to pose the same question to you. So ladies first.
Okay, single biggest risk. I guess, you know, you're asking this question with regards to, you know, specifically interest in income funds.
Yes, absolutely.
Yeah, I guess the risk for these funds is, you know, they've had a nice tailwind from, you know, the big bond rally and from interest rates coming down. Is really just, it moves in the opposite direction. I would say I don't think it's keeping me up at night. You know, famous last words. But it's not keeping me up at night because we've taken a lot of risk off the table. So we now
quite cautious.
Yeah. We're now in the income fund. We're about 40% money market, in the interest fund about 50 now.
Right.
It's sort of goes kind of live. So a lot of that risk has come off. So. Yeah, not as concerned about that. Whereas there were points last year where I was thinking, okay, you know, we've had a nice run from this. If things turn, and again, that also, you know, I spoke to cutting the credit-linked note exposure. Yeah, I would say that those are the big risks right now. You know, previously at previous points in, you know, the cycle, I might have said, and you know, I could speak more to maybe multi-assets when answering this question. Yeah, we would have been concerned about political cycle and, you know, obviously, you know, the famous 2024 national elections.
Yes.
But yeah, I think things are probably going to be quiet between now and 2029, or we're going to be just, you know, waiting for data points to come out on, you know, the local government elections. But that's not going to tell you the final story, which is, you know, let's say ANC loses even more support. And, you know, is performing quite poorly, like, you know, 30s, low 30s, whatever it might be. It's not going to give you insight as to who the next coalition partner is going to be.
Of course.
So I think that would probably be the next big risk for SA government bonds. Yeah.
And what are you excited about? Before we get to that point, you know, the risk to, you mentioned the risk to SA government bonds, but are we maybe going to see, you know, growth come through from, you know, the dollar debasement, from your, you know, your tax, from your corporate taxes? Is that going to translate into maybe, you know, growth and, you know, increase your, you know, potential for growth within the economy? And then that's obviously positive for your bonds. Or do you not think that that's going to happen?
Corporate taxes?
Yes, from the commodity tax windfall.
Okay. Yeah, so I think so corporate income tax collection, I mean, it will be higher than what it would have been, you know, without this commodity tailwind. I think if one was purely looking at the behavior of the Offshore index and what, you know, the resources sector has done there, it's actually quite misleading because a lot of those companies are, you know, don't necessarily have mining operations in South Africa. So Anglo Gold is a you know, one example where they've exited SA from an operational standpoint. Even Goldfields, the SA exposure is very low. So there is a bit of a disconnect where you're seeing this huge tailwind coming through in the shares in the All Share Index, but it's not necessarily going to be, you know, one-for-one translation into corporate income tax collection, where it, you know, can come through. And I think, to be honest, a lot of that pricing is already, you know, people are feeling excited about that, and foreigners in particular, is for our trade surplus. So yeah, and yeah,
that's going to be positive.
Yeah.
What are you excited about? I'm watching the time. Henk, I'm going to give you your time.
No problem.
Okay. I mean, I tend to think, you know, the excitement has passed us. The excitement has been 2 years of clipping, you know, 20% per annum on bonds. I think from here, you know, I wouldn't expect, you're not going to get another 20%.
Okay, nothing to be excited about.
Well, yeah, from here, I think the big capital gains are done, and yield is probably, you know, your best estimate of kind of returns over the next while. Yeah.
Hank, what are you excited about?
So last year, the real return in the portfolio was the second highest on record.
Oh, well.
So I've some 25 plus years, only second to 2024. Okay, so we've been in a very Goldilocks period for front-end rates or fixed income rates in South Africa from a real yield perspective. And given sort of fund yields and where we still see levels, we think about a fund yield around 8.5 for our income fund, inflation gets to say 3.5%.
Still attractive?
It's still exceptionally attractive.
Yes.
So very excited about the real yield in the local market in the front end. We've also taken risk off. We're also quite defensive. Sort of end of last year, we started to take the foot off the pedal a little bit. But that doesn't mean that structurally in the front end, we still earn exceptionally high real yields. And yeah, long may that last for us who get to earn them.
So nothing to be cautious about? nothing sort of keeping
No,
you
no.
up at
I mean,
night?
there's lots of structural things we're thinking about. We are defensive. I mean, we're not overly bullish on too many asset classes. So from a sort of macro perspective, it won't keep me up, but just be cautious. But we've taken risk off. So
Okay.
I won't say I'm waking up in the middle of the night thinking, oh no, hope nothing happens. And then there's a lot of diversification in portfolios that helps you, et cetera, et cetera. So fairly structured defensive, but still exceptionally high real yields.
All right, so a lot of positivity coming through from our fixed income managers. Henk and Thalia, thank you so much for your valuable insights. We appreciate it.